Dividend investing is often marketed as a passive income dream, yet many investors find themselves disillusioned within the first 24 months. The primary issue isn't a lack of high-quality companies or a volatile stock market. Rather, it is a psychological and mathematical disconnect regarding the monthly contribution level. Most beginners are operating below a very specific financial noise floor, a level where the dividend snowball is technically rotating but remains virtually invisible to the naked eye. This invisibility is the primary reason the average investor abandons the strategy before it ever has a chance to mature. When you consistently allocate capital into blue-chip, dividend-paying equities, you are essentially building a machine. However, in the early years, the output of this machine, perhaps $15, $32, or $50 a month, does not feel like income. It feels like a rounding error. It doesn't pay the mortgage, and it doesn't buy a grocery haul. Consequently, the investor begins to question the validity of the entire system. The uncomfortable reality is that the strategy is performing exactly as intended. The investor is simply operating at a scale where their personal contributions are doing 99% of the work, making the dividends feel irrelevant. The math of the dividend illusion. To understand why this happens, we must look at dividend income as a game of percentages rather than absolute dollar amounts. A healthy, sustainable dividend growth portfolio typically yields between 3% and 4% annually. This means that for every $10,000 you have managed to save and invest, you are generating roughly $300 to $400 per year. Broken down monthly, that is a mere $25 to $33. For many, reaching that first $10,000 milestone takes significant effort and discipline. To receive only $30 a month in return for that effort creates a perception gap. Investors expect the dividends to behave like a secondary salary from day one. But in reality, early-stage dividend investing is a capital accumulation phase masquerading as an income strategy. Until the portfolio hits a critical mass, your monthly deposits are the only thing moving the needle. The dividends are merely a small bonus that gets folded back into the capital. This is why a person investing $200 a month feels like they are running on a treadmill. The growth is happening, but the dividend output is still tethered to a small principal base. Comparative scenarios: the power of the base. Let us examine the stark difference that monthly contribution levels make over a 10-year horizon. Consider 3 separate investors, all achieving a 7% total return with a 3% dividend yield. The micro investor, $50 per month. After a decade of discipline, this investor has contributed $6,000. Their portfolio sits around $8,500. Their monthly dividend check? Roughly $21. After 10 years of waiting, the reward feels disconnected from the sacrifice, leading most to quit. The standard investor, $200 per month. This individual has put in $24,000 over 10 years. The portfolio grows to approximately $34,000. Their monthly dividend is now $85. While this covers a small utility bill, it isn't life-changing. The investor still feels like they are doing all the heavy lifting. The threshold investor, $400 per month. By doubling the contribution again, the math shifts into the realm of the visible. After 10 years, they have $48,000 in contributions and a portfolio valued near $68,000. Their monthly dividend is now $170. At the $170 per month level, the psychology changes. This is no longer pocket change. It is a tangible sum that offsets a significant expense. More importantly, the investor can finally see the machine starting to take over. The difference between $21 and $170 isn't found in a better stock pick or a higher risk yield. It is found entirely in the size of the monthly fuel provided to the system. The return versus contribution trap. A common mistake made by those frustrated with slow progress is yield chasing. Investors believe that if their $200 monthly contribution isn't working, they need to find stocks that pay 10% or 12% dividends. This is a dangerous path that often leads to capital loss. In the formative years of a portfolio, your savings rate is a much more powerful lever than your rate of return. If you are investing $200 a month and manage to double your return from 7% to a staggering and unlikely 14%, your portfolio after 10 years might reach $52,000. However, if you simply stick to a safe 7% return but increase your contribution to $400, your portfolio reaches $68,000. The lesson is clear. Chasing higher returns introduces massive risk for a smaller gain than what can be achieved through lifestyle discipline and increased contributions. Percentages only matter when the base is large. When the base is small, the only number that truly matters is the dollar amount you transfer into your brokerage account every month. Strategies for acceleration. If the goal is to reach the visible stage of the snowball faster, you must look at 3 specific levers of acceleration. The incremental step-up. You do not need to find an extra $500 today. If you increase your monthly contribution by just $50 each year, you create a secondary layer of compounding. This contribution compounding drastically shortens the time it takes for the dividends to become meaningful. Non-negotiable reinvestment. The moment you spend a dividend check in the early stages, you are essentially cannibalizing your machine. Reinvesting every cent is the only way to ensure the snowball gains the mass required to eventually sustain itself. The income investment link. Most people fall victim to lifestyle creep. When they get a raise at work, their spending increases to match it. To win at dividend investing, a fixed percentage of every salary increase should be diverted directly to your portfolio. This ensures that as you become more successful in your career, your wealth machine grows at an accelerated pace. The behavioral finish line. The math of dividend investing is simple, but the behavior required to see it through is incredibly difficult. We live in a world of instant gratification, and a dividend snowball is the antithesis of instant. The boredom zone, those middle years where you are doing everything right, but the results still look small, is where wealth is actually won or lost. The people who succeed are not necessarily the smartest stock pickers. They are the ones who understand that the early phase is a test of endurance. They recognize that $20 a month in dividends isn't a failure. It is the first green shoot of a forest that will eventually provide shade. Conclusion. Building for the long term. The dividend snowball is an inevitable force of nature, but it requires a sufficient starting mass to overcome the friction of inflation and taxes. If your journey feels slow, do not blame the strategy or the market. Instead, look at your input. Are you feeding the machine enough to make the math visible? As your income grows and your contributions scale, you will eventually cross a threshold where the dividends grow faster than your ability to add cash. That is the tipping point every investor dreams of. But to get there, you must be willing to stay the course when the numbers are small, increasing your base and trusting that the math of compounding never sleeps. Every dollar invested today is a silent worker for your future self. Feed the machine, stay patient, and let the scale work in your favor. Every dollar invested today is a silent worker for your future self. Feed the machine, stay patient, and let the scale work in your favor. Look at the S&P 500 today, up over 1% and hitting the 7,339 mark. While most people see just a green line, smart investors see the collective growth of the top 500 companies in the U.S. This is exactly why you don't bet against the American economy. It's not about timing the market, it's about time in the market. If you're not invested yet, you're missing out on this compounding machine.